In this video, we're going to talk about how to use the lower of cost or market rule to value inventory. So we record inventory at cost when we purchase it, but the thing is that as inventory sits on your shelf, its market value might decline. And if its market value declines to actually be lower than the cost, then we're going to need to write the inventory down. And that's going to involve us taking a loss that's going to be charged against net income, and it's actually also going to result in us reducing inventory on the balance sheet. So let's talk about how we would go about valuing market, right? Because we know the cost, we can figure that out, but how will we go and determine what the market value is that we would compare to cost, right? If we're going to take the lower of cost or market, we need to be able to figure out what is the market value of the inventory. And normally we're going to use replacement cost as a proxy for the market value of the inventory. However, there's a couple of caveats to that. And one is that the market value cannot exceed the net realizable value of the inventory. And net realizable value, I'm going to make another video specifically on that, but it's basically the amount that the sales price that we're going to receive or we expect to receive from the inventory, so the sales price, less any costs that are going to be required in order to dispose of this. So let's say you're going to need a sales commission to your salespeople to sell this inventory. Well, okay, so we'll take the sales price and then less the sales commission that's going to take to complete the sale. So that would be your net realizable value. And we'll get into that more in another video. So that's going to be the ceiling of this market value. But then we're also going to have a floor. And the floor is going to be that the market value, this market price, cannot be lower than the net realizable value less a normal profit margin. Okay, so that's the floor and this is the ceiling. Now I know this probably makes this sound really complex and it is a convoluted way to compute the market value, but let me just walk you through a really easy way to think about it. All right, so if we just kind of forget about all this for a moment and just think about it a really simple way. If you just know the three values here, if we know the replacement cost, the net realizable value, and the net realizable value less the normal profit, if you just take those three values, you always take the middle one, the middle value of those, right? So let's say that this was 10, this was 8, and then this was 6. Then 8 is in the middle, and so that would be the market value, right? And then we would then compare that market value to the cost, and then whichever was lower, that would be how we would value the inventory. So you just want to take the middle of these three. Now bear in mind, the middle value of these three here, that is not what necessarily is going to be the inventory value, right? So we still have to compare it to cost, but we have to figure out market first, right, to compare to cost, and that's going to be the middle value of these three. So let's walk through an example. It'll make it a little bit easier. So and again, we're just going to be taking the lower of cost or market, which is the middle value of these three here. We're just going to apply that in our example, and it'll make it a little easier for you to understand. So let's say that we have some inventory that the original cost of this inventory was $100. And then now we need to know, in order to figure out the market, we need to know the replacement cost, the NRV, and the NRV less than normal profit, right? So those things have to be given for you to be able to figure this out. So let's say that the replacement cost is $75, right? So if you were to replace that inventory right now, it would cost you $75 to get that inventory, right? So the net realizable value is $82, and then the NRV minus a normal profit is $67, okay? So now, what we have to do is first, before we can figure out the value of the inventory, we need to figure out that market value, right? So we're going to take the middle of these three in purple right here, the middle value. So we've got 75, 82, and 67. So the middle value is going to be 75, right? So that, and let me just change, we'll make the colors consistent here. So that's going to be 75. So what is our inventory value going to be? Well, our inventory value, we're going to now compare the market, which is this middle value. That's our market value. So we're going to compare that, 75, to the original cost of 100. And the lower of those two, the lower of the 100 with the cost and then the 75, the market, is our inventory value. And the lower is 75. 75 is less than 100. So our inventory value, our inventory should be valued at $75. Here's the thing. We bought it at 100, right? So we bought this inventory at 100, and now we say, hey, it should be valued at 75. So what do we have to do? Well, we're going to have to make a journal entry, right? Because we've had a decline in the inventory's value. So we're going to do what's called a write down. We are going to write the value of this inventory down to where it should be. So it's at 100 and it's supposed to be at 75. So if we take 100 minus 75, that equals 25. And so that means that we need to drop the value of this inventory by $25. Now, inventory is an asset, so that means it decreases with a credit, right? So we're going to have a credit to inventory here of $25. Now we have a corresponding debit. What is the debit going to be? Well, it's going to be $25, and we'll just call it a loss. You can just specify loss from decline in inventory value, right? Now, this loss is going to go to the income statement, and it's going to reduce net income. Okay, and then this inventory credit of $25 is going to go on the balance sheet, right? This is going to reduce the value of our inventory on the balance sheet. It's going to go from $100, which it was before when we had it at cost, and now we've written it down, and it's going to be valued on the balance sheet at $75.